For Morningstar, I'm Jeremy Glazer. Here at the Morningstar ETF conference, I'm joined by Joe Davis. He's Vanguard's global chief economist. Joe, thanks for joining me.
Oh, thanks. Pleasure to be here, Jeremy.
Yeah, so it's nice to speak to you now. Last time we spoke, the Dow was down 1,000 points, so
yes.
A little bit calmer now. But a lot of those worries are still out in the market. And particularly now the Fed has said that they're not raising rates because they're worried about some of these global issues. Do you think the Fed is going to raise rates anytime soon? Is December still a real possibility?
I think so. I mean, clearly, Jeremy, we went into the year saying two things. One is that in part because the labor market is a little bit tighter than perhaps the Fed thinks, in part because Americans may not return to the labor force as quickly as the Fed had anticipated, that implied two things. One is that in part because U.S. growth was going to hold up in an otherwise frustratingly fragile world. And when you put those two together, you come to the conclusion of the Fed is still likely to raise rates, but that path is very moderate, and we have not changed our view that over the next several years, the Fed will be hard-placed to raise rates, say, above 1%. So again, it's removing some of the exigent circumstances that the Fed exercised in 2009, dropping below 1%, and then hence QE. So I'd characterize it more as a path of a dovish tightening rather than as just a march towards 2 or 3, 4%.
How about inflation? It's still running low. The PC numbers this week were still low. Do you think Yellen's right that we are going to get back in the medium term to that 2% level?
I think so. I mean, I think, understandably, for the Federal Reserve or for any economist or central bank to be reasonably confident the Fed's going to achieve 2%, they're waiting to see, more stabilization rather than rebounds in the commodity markets in U.S. dollar, which, there is a limit to how further they can fall. And so, that said, core inflation has been roughly below 2% for half of the past 20 years. And so in our minds, there's still a deflationary bias in the world globally, given what we continue to see in both out of China and the emerging markets. So I think, ultimately, core inflation should converge to that 2% level, but it could take out to 2018 before that's ultimately realized. Now, the Fed is trying to anticipate that, and again, trying to remove some of that excessive accommodation that they've had.
Let's talk about China. Do you see anything new there that shows that they are slowing maybe even more than we thought a month ago, 2 months ago, or have things stabilized?
Well, I think actually it's one of these things that at least internally, and various firms such as ourselves will have leading indicators that suggest where the real feel economy for China may be, knowing that their official growth target is around 7%. And for more than a year, Jeremy, as you know, our leading indicators were suggesting a real feel growth rate closer to 5%. Actually. So we were not surprised to see this become more prominent in the marketplace. I think, however, what was news, because the slowdown is not news longer term, it's been, I think, the pairing of weaker than expected economic activity during the summer paired with the surprise devaluation. I think some in the marketplace put those two together and at least feared that perhaps growth is even weaker than potentially 5% in a real feel context. But I think the best we can hope for, and I think what's actually part of the plan out of China, is more of a stabilization in growth to 5%. But I think it's unrealistic for anyone to assume that we're going to see the sort of heady growth rates that we've had in the past. It's not part of the plan, nor is, I think, healthy ultimately for the global economy.
But the U.S. can keep growing without China?
It can, but it's up to a limit. Our central tenet of our secular outlook was one of resiliency for the U.S. Now, that said, we don't want to be too complacent on that view. I think there's around 20% of the U.S. economy that has, if it's not in recession, it's flatlining at best. And those are sectors of the manufacturing and export-intensive industries, which are very closely tied to global growth. But when you look outside of that, we still are of the mind that the U.S. economy can grow roughly 2.5% and modestly add to job growth, although it may be slower the next 6 months than it has been at the previous year. And so it's still, consistent with probably still the only major economy in the world that will grow modestly above trend. So we're still reasonably confident in that view, but there's a limit by which if we continue to see weakness further accelerate, which is not our base case, then I think, there would be a natural spillover to the U.S.
what's the takeaway for long-term investors then? Is this a time to make some tactical moves, to rebalance? How do you think about that?
Well, clearly one wants to rebalance the plan, and one's always, revisit the plan. I'd say two things. One is, we went into the year, Jeremy, as you know, as having the most guarded capital outlook that we've had since 2006. Not terribly bearish, but concern around froth, and quite frankly, various segments of the financial markets in the equity and fixed income markets that, ironically, some investors went to avoid a fear of rising rates. And so things such as emerging market debt, high yield bonds or REITs and so forth. And those sectors have actually, emerging markets have come under considerable pressure. Despite the correction, we still have a guarded view, in large part because the valuations and the risk premiums haven't risen materially enough that would lead to higher expected returns. So we're still guarded. And so I think investors, should really two things: stick to their plan, because we're not, incredibly alarmist or extremely bearish. But I don't think, taking outside risk positions are going to be terribly rewarded by investors given the current context. This is not 2009 where, unless the world ended, one was going to be rewarded ultimately with higher expected returns. That's not the case at present.
Joe, thanks for your thoughts today.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.